This presentation is designed to help you prepare for the MLO SAFE Test, a key exam for mortgage loan officers. We will walk through the essential topics, tips, and strategies to ensure you're well equipped to pass the exam with confidence. Whether you are new to the industry or looking to brush up on your knowledge, this guide will provide valuable insights and resources to help you succeed. Let's dive into the core concepts and important details of the MLO SAFE Test. Let's start with qualification, processing, and underwriting overview. The main areas of focus during the loan qualification process are the borrower analysis, asset verification, liability analysis, and income verification. Borrower analysis looks at the overall financial health of the borrower, including their credit history and payment behavior. Asset verification ensures the borrower has enough funds to cover the down payment and other expenses. Liability analysis checks the borrower's existing debts and obligations. Finally, income verification makes sure the borrower has a reliable and sufficient income to make the loan payments. Now, let's look at borrower analysis assets. For down payments, the lender will require at least 2 months of bank statements to show that the funds have been in the account for a while. This is called seasoned funds. If there are large deposits, over 50% of your monthly income, you'll need to explain where that money came from. If you're selling your current home, you'll need to provide the closing disclosure to verify the sale and ensure you have enough money for the new loan. If you're using gift funds, you'll need a gift letter that confirms the amount, your relationship to the giver, and that the money doesn't need to be repaid. If you're selling other assets, such as an RV or a car, proof of ownership will be required. Borrowed funds, like credit card advances, are not acceptable, but secured funds, such as from a 401k, are fine. Finally, cash on hand is not allowed for the down payment or closing costs. Let's go over the allowed and not allowed assets. Acceptable assets include bank savings, investments like stocks, CDs, and money market accounts, retirement savings, and vested life insurance policies. On the other hand, there are things you can't use, such as non-vested funds, funds that can't be withdrawn, stock in unlisted companies, unsecured loans, interest-party contributions, and cash from a cash-out refinance on the property. Now, let's talk about liabilities. For revolving accounts like credit cards, the lender will consider 5% of the unpaid balance if no minimum payment is shown. For installment loans, such as car loans, these can be excluded if there are fewer than 10 payments remaining. Auto leases are always included in the liability calculation. For student loans, if there are fewer than 10 payments remaining, they can be excluded. If they are deferred, they must be included. Contingent liabilities, like co-signed loans, may be excluded if the payments have been timely for the past 12 months, and the primary borrower is making the payments. Some non-liabilities like utilities, cell phone bills, insurance, taxes, union dues, and 401k contributions are not counted against you. Moving on to income verification. Stable income is typically from base salary, W-2 forms or tax returns, consistent hourly wages, Social Security benefits, retirement income, or long-term disability payments. Variable income includes commissions, bonuses, overtime, calculated at 1.5x the hourly rate, and income from self-employment if the borrower owns at least 25% of the business. The lender will also look at second job income, which needs a 2-year history along with verification through a VOE, pay stubs, and W-2 forms. Income continuity is important, too, and generally, the lender wants to see at least 2 years of consistent work in the same field. For income like alimony, child support, or retirement, it needs to be verifiable for at least 3 years. For income verification based on property types, if the property is an investment property, the lender will need to verify 6 months of PITI, principal, interest, taxes, insurance, payments. For owner-occupied properties, the lender will require 2 months of PITI payment history. Additionally, they'll want to see a 12-month payment history on your previous mortgage to ensure you have a good track record of making payments. Next, let's talk about non-taxable income, also known as grossing up. Non-taxable income includes permanent disability payments, Social Security benefits, and child support. For these types of income, the lender will apply a gross-up factor of 1.25 to account for the fact that it's not taxed. If you have rental income, the lender will look at your Schedule E to calculate the average income and expenses over 24 months. If you don't have a Schedule E, they'll apply a 75% vacancy and maintenance factor to the gross rent amount, subtracting the PITI. For self-employed borrowers, the documentation required is a bit more extensive. You'll need to provide 2 years of tax returns, including business tax returns if applicable. For S corporations, you'll provide Form 1120-S, for C corporations, Form 1120, for partnerships, Form 1065, and for sole proprietorships, Schedule C from your Form 1040. Finally, let's go over the different methods of income calculation. For annually paid income, you simply divide your annual income by 12. For monthly income, it's straightforward, just use the monthly income figure. If you're paid semi-monthly, you multiply the semi-monthly income by 2. For bi-weekly pay, you multiply the bi-weekly income by 52, then divide by 12 to get a monthly figure. For weekly income, you multiply the weekly income by 52 and then divide by 12. And if you're paid hourly, you calculate the hourly rate times the number of hours worked per week, then multiply by 52, and divide by 12. Credit Report Overview. Alright, let's start with the basics. A credit report is like a financial report card that shows how well you manage your debts. There are 3 major credit reporting agencies: Equifax, TransUnion, and Experian. When you apply for a loan, the lender might pull a tri-merge report, which combines data from all 3 agencies. If they pull all 3 reports, they usually pick the middle score. If they only pull 2, they go with the lower score. Credit scores range from 300 to 850, and the higher your score, the better. Also, before a lender can pull your credit report, they need your signature to authorize it. Now, let's talk about what affects your credit score. The biggest factor is your payment history. If you've been more than 60 days late on a mortgage payment in the last year, it could lead to a denial, unless there are special circumstances. Other factors include how much of your available credit you're using, credit utilization, the types of credit you have, credit mix, how long you've had credit, age of credit, and any negative marks like bankruptcies, foreclosures, collections, or judgments. Speaking of bankruptcies, Chapter 13 stays on your report for 7 years, while Chapter 7 stays for 10 years. Foreclosures also stick around for a while, depending on the type of loan. Credit report, when borrower doesn't have traditional credit score. What if someone doesn't have a traditional credit score? No worries, lenders can still evaluate your creditworthiness by looking at alternative data. This could include your history of paying utilities, rent, or insurance. So, even if you don't have a credit card or loan, you can still show you're responsible with your bills. Bankruptcy impact on different loan types. Bankruptcy can have different impacts depending on the type of loan you're applying for. For example, if you filed for Chapter 13 bankruptcy, you might have to wait 2 years before getting a conventional loan, but only 1 year for an FHA, VA, or USDA loan. Chapter 7 bankruptcy is a bit stricter, with waiting periods ranging from 2 to 4 years depending on the loan type. Foreclosures and short sale impact. Foreclosures and short sales also affect your ability to get a loan. A foreclosure can stay on your report for 7 years with conventional loans, but only 2 to 3 years with government-backed loans like FHA, VA, or USDA. A short sale, where you sell your home for less than what you owe on the mortgage, has similar waiting periods, usually between 2 to 4 years. Credit utilization and inquiries. Credit utilization is another big factor. Basically, the less of your available credit you use, the better. Lenders see you as less risky if you're not maxing out your cards. Also, every time someone checks your credit, an inquiry, it stays on your report for 2 years and can affect your score for up to 12 months, especially if it's recent. If your credit report doesn't show the minimum payment, lenders might use 5% of your outstanding balance to calculate it. Qualifying ratios. When lenders decide if you can afford a loan, they look at your income and expenses. They use different methods to calculate your income, depending on how often you get paid. For example, if you're paid twice a month, they'll multiply your paycheck by 2. If you're paid weekly, they'll multiply by 52 and then divide by 12 to get your monthly income. Ability to repay mortgage rule. Lenders have to make sure you can actually repay the loan. They look at your credit history, income, debts, and your debt-to-income ratio. If you're applying for an adjustable rate mortgage, ARM, or a loan with negative amortization, they'll also consider the highest possible payment you might have to make. Tangible net benefit. If you're refinancing, the lender has to make sure the new loan actually benefits you. This could mean lowering your interest rate, reducing your monthly payment, or shortening your loan term. Other benefits might include switching from an ARM to a fixed-rate mortgage, removing private mortgage insurance, PMI, or consolidating debts. The key is that the benefits should outweigh any costs or negatives. Finally, let's talk about churning. This is when someone refinances their loan multiple times in a short period just to generate fees for the lender. It's not a good practice and should be avoided because it can end up costing the borrower a lot of money without providing any real benefit. Congratulations on taking the next step toward becoming a certified mortgage loan officer. We hope this study guide has provided clarity and a solid foundation for your exam preparation. Remember, success comes with dedication and practice. Stay focused, keep reviewing, and you'll be well on your way to passing the MLO SAFE test. Good luck with your studies, and feel free to reach out if you have any further questions or need additional resources. Stay confident, and you've got this.